Let's take a look at the David Swensen Yale Endowment portfolio and how it would have performed if we had invested $1,000 a month in it for the last 20 years, and how that performance would stack up to a simple 3-fund portfolio. So the David Swensen Yale Endowment portfolio was proposed by none other than David Swensen himself in his 2005 book, Unconventional Success, where he proposed this simple 6-fund model that would get returns similar to that of the Yale Endowment Fund, which he was the manager of. He was the manager of Yale's Endowment Fund from 1985 to his passing in 2021. So he had a solid career as a fund manager. And this portfolio right here, and this asset allocation, is what he proposed so that average investors could get returns similar to that of the Yale Endowment Fund. It's comprised of 30% stocks, 20% REITs, and I should specify that's US stocks. So 30% US stocks, 20% REITs, 15% international stocks, 5% emerging markets, 15% long-term treasuries, and 15% tips. This is a 70-30 portfolio. We can see 70% invested in stocks, and well, you can add up the bonds, 15% long-term treasuries, 15% tips. I would not call this a growth portfolio. I would call this a moderate portfolio at its allocation here of 70% equities, 30% bonds. And that said, REITs fall into the equity category because they're going to be holding REIT stocks or REITs as an asset class, and subsequently stocks that have a lot of exposure to real estate. One thing that jumps out at me as interesting here, may or may not be of significant value, is he's got two wildly uncorrelated types of bonds, like, basically pretty far at pretty far ends of the spectrum, I guess we could say. Long-term treasuries are the most volatile types of bonds. Tips are pretty stable, maybe a little bit more volatile than a cash equivalent of like short-term treasuries. One option might be just combining these with like 10-year treasuries. But anyways, we'll talk about that in a second here. Let's put these into a back tester and look at performance, and also put some 3-fund portfolios onto the same chart. Right? So here I've got Portfolio Visualizer open, and I've got the allocation for the David Swensen portfolio, right? The 30, 20, 15, 5, 15, 15. I've got that here. We can see it, 30% US stocks, 20% REITs, 15% international developed, 5% emerging markets, 15 long treasury, 15 tips. Okay, so that's the David Swensen Yale Endowment portfolio. Now, also on here, I put a traditional Bogleheads 3-fund portfolio on here with the equity allocation, the equity exposure allocated to 70%. So it would fall in at 43.75% US stocks, 26.25% global stocks, excluding the US. Notice here on the Yale Endowment portfolio, we allocated between international developed and emerging markets. This global, excluding the US, will have exposure to emerging markets, but not that much. Right? So in this model, the David Swensen portfolio model, 25% of their international stock exposure is allocated to emerging markets. So if we added up 15 and 5, it'd be 25% of that going to emerging. So therefore, we could say that 25% of the international exposure is emerging markets. The 3-fund portfolio will not have quite that. And then over here, I put on what I call my Corey Twist portfolio on the 3-fund, right? So that is 52.5% in US stock market, 17.5 emerging markets. Okay, so that's where the twist is, in 30% total US bonds. So I adjusted my 3-fund twist portfolio, which holds 75% of its equity exposure in US stocks and 25% of its equity exposure in emerging markets. I adjusted that here, considering we have 70% allocated to emerging markets, 25% of that 70 is in emerging markets at 75%. Let me go back and clarify that in case I misspoke here. My twist on the 3-fund portfolio would include 75% of the equity exposure to US stocks and 25% of the equity exposure to emerging markets, not just broad market international. So If we adjust that out, what we'll see here, if we adjust that out and set the allocation of equity exposure in my 3-fund portfolio to 70%, 25% of that 75% would be 17.5% of the overall exposure of the entire portfolio exposed to emerging markets. Okay. So yeah, we got 52.5, 17.5, and then 30% in bonds. Therefore, we've got my 3-fund twist portfolio at 70-30, and 25% of the equity exposure in emerging markets, right? So let's pop these on a back test here, and we are limited in this data for tips back to 2001, so January 2001 through the end of February 2022, and we can see the returns, right? The David Swensen Yale Endowment portfolio did outperform all of the others with a compound annual growth rate of 8.05%. So $10,000 invested on a total return basis would have grown to a final balance of $51,508. So what a 5x your money over this 21-year period. And then the worst performer was the Bogleheads 3-fund portfolio. $10,000 invested in that would have grown to only $38,720 at a 6.60% compound annual growth rate. And then the Corey Twist portfolio with emerging markets in there, $10,000 would have grown to $47,601. So a little bit closer to the Yale Endowment at 7.65% annually. So that's how they stack up here based on a static investment of $10,000. But fundamentally, I don't like looking at this because this is not how we invest, right? We should be investing a little bit here and there, investing a little bit with every paycheck, every other week, investing an amount each month. Personally, for me, because I am self-employed and get income from businesses that I own, I invest a percentage of money as I take distributions from these businesses. Some businesses where I'm the sole owner, I basically take a distribution every week for whatever excess cash we have. That might not be every week. Some of the businesses I have in partnership, I take a drawing every quarter. I might not get it every quarter, so I don't really know, but I allocate a percentage of my distributions from my businesses into my portfolio. Anyways, the bottom line is I'm not just investing a one lump sum and then waiting, and you should not be either. But I know a lot of investors tend to get anchored to these one lump sum type of things. Like, ooh, wow, if I'd invested 10 grand there, it would be worth $51,000 now. But that's really not how we invest. We should be investing a little bit over time. So I am going to change this to have an initial investment amount of $1,000. We're going to contribute a fixed amount of $1,000. And then there's this inflation adjustment. I'm going to select no on here just so we look at the raw numbers, because it doesn't necessarily detail out for us what the inflation adjustments were. So to simplify this model and simplify how we look at it, I like to just set this to no. And then contribution frequency monthly. So we're going to start with $1,000, and each month we are going to put $1,000 into it. Let's just see what happens here. This is where things are going to get interesting, right? Okay, so when we look at it here, and let's switch it to a non-log on our scale, the Corey 3-fund twist comes out a little bit ahead with $694,000 final balance. Damn, I feel like a genius here. I beat the David Swensen Yale Endowment portfolio, and I beat the Bogleheads 3-fund portfolio. Wow, I'm just a guru, right? No, I'll talk about this in a second, but it's cool. It's cool when I'm right. I like feeling right, and I guess I'm not trying to be right here. I'm just trying to show different alternatives. But it's cool when my alternative is the best performer. So anyways, I'm a little happy about that. But yeah, I mean, bottom line is this is really nothing to be excited about for myself personally. Let's just look at the numbers here. So yeah, $1,000 with $1,000 a month final balance in the Corey 3-funder would have been $694,056. The David Swensen Yale Endowment would have grown to $690,000. And the 3-fund Bogleheads would have grown to $630,000. So between all of them, there's really not a life-changing difference, right? Like if you started investing back in the year 2001, and these were the numbers you walked away with, you're not going to be saying, hey, I'm going to buy a mansion and a yacht because I invested in the Yale Endowment Fund or the Yale Endowment Portfolio by David Swensen or the Corey 3 Fund, instead of investing in just the Bogleheads 3 Fund. So there's really not a wide difference between all of them. When it comes to drawdown, the Yale Endowment by David Swensen did have the highest drawdown. I'm going to guess that is because it had such a high exposure to real estate. During this time period here, we can all remember it from 2008 to 2010, real estate had a very large drawdown, and that was larger than the S&P 500. On a risk-adjusted return basis, though, measured by the Sharpe ratio, I'm surprised to see the Yale Endowment Fund up there at 0.64%, even a little bit better than my proposal on the 3-fund portfolio. What else haven't we covered here? Let's just see. What do I think about these portfolios here? What do I think about the David Swensen Yale Endowment portfolio here? And what do I like or not like? Well, one thing that jumps out to me is that the portfolios that had exposure to emerging markets, and that being the David Swensen Yale Endowment portfolio, that had a 5% allocation to emerging markets specifically. And then the Corey 3 Fund portfolio allocated 25% of its equity value to emerging markets. So that was, I think, 17.5% to emerging market. Whereas the 3-fund Boglehead really doesn't have any exposure to emerging market, like just a couple percent, whatever, and maybe not even a couple percent. It probably works out to like 1 or 2% of the entire portfolio. Just whatever is in its global excluding US, whatever percent of that is emerging markets. That's all that this one gets here. And from 2000 to basically 2010, emerging markets did very well. And historically, emerging markets are the lowest correlated equity asset class to US stocks. So there's a lot of diversification value in holding emerging markets. And while they, underperform during these periods from 2010 onward, emerging markets have just been absolutely abysmal. When they do outperform, they outperform well, and they outperform and underperform at different times than US stock market. So I think that is interesting, and I think that is why, or potentially one of the reasons why, these two portfolios, the David Swensen and the Corey 3 Fund, have outperformed that Bogleheads 3 Fund. The other, I think one of the big factors too for the Yale Endowment by David Swensen is the fact that it has significant exposure to REITs, which have done very, very well, have done very, very well for the last 10 years and have done very well for the last 20 years, even despite the great financial crisis and the big real estate collapse and bubble that subsequently happened there. So my final thoughts on this are, two things. Number one, if you like the Yale Endowment portfolio and you like this exposure to REITs and you think that REITs and real estate are going to continue to have strong performance going forward in the future, there's no reason why you couldn't or shouldn't hold the David Swensen's Yale Endowment portfolio. There's really no reason why you could or shouldn't. Yeah, like I said, you can get all of these exposure to these asset classes from low-fee funds. Basically, you can get all of these from Vanguard, Schwab, or probably even Fidelity and implement this yourself. I will put a link below to this portfolio and asset allocation using the lowest fee funds that I can find on M1 Finance below. So yeah, if you like this portfolio, go ahead with it. That said, there's really no reason to believe that this, or at least no significant reason I can see to believe this portfolio is going to continue to outperform. We could go into an economic environment where this simple Bogleheads 3 Fund portfolio outperforms. So I guess I'll share with you on a final parting note, one of my videos that I did, and where is it? This one here. What if we applied a 1% fee to the best asset allocation? And in this video, I look at some data on over 40 institutional asset allocations. And these institutional firms that manage these allocations basically have pages on pages on pages and data and documents substantiating why they have this asset allocation, why they have 45% in US equities, 17% in international equities, and 11% in emerging markets, right? And, just right down to the percent, all this data on why they have that percent. But over a 40-year period, if you took the best performing, I got a phone call. If you took the best performing asset allocation and applied just a 1% fee on top of that, it suddenly makes it the worst performing asset allocation. So fees matter, low fees matter, taxes matter. And if we look at this here and we look at the, we can look at the time weight. Let's look at the money weighted rate of return on here, I guess, because this one is a lot closer. When we look at this, the best performer in this one here had a 8.63% annual money weighted rate of return, whereas the Bogleheads 3-fund portfolio, the worst one, had a mere 7, or didn't have a mere, but it had less than a 1% lower money weighted rate of return, right? So if you had the 3-fund Corey here and you put a 1% fee on top of it, it would suddenly become the worst one. So that really just, to me, highlights the value of having low fee funds in your portfolio and simplicity, right? Because in all of these asset allocations that I look at, there's a bunch of asset classes and a bunch of data, being like, oh, hey, this is why we have this and this is why we hold that, yada, 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 a 50-page white paper. But at the end of the day, over a time period, what really matters is the allocation between stocks and bonds. And that's something that's dependent on your own time horizon. Over a long period of time, stocks generally do better. But more importantly, the fees that the portfolio has. So guys, that is a wrap on this one. I hope you found this helpful and insightful for those of you guys out there looking into the David Swensen Yale Endowment portfolio or considering investing in that portfolio. If you have any questions or if there's any details you feel like I missed, let me know in the comments below. I'm signing off on this one, guys.